We just have a quick question here from Colio asking for some information about the different types of forward guidance that central banks can use. So, thanks for the question, Colio. So, we can basically divide the different types of forward guidance into three. Namely, the first one being outcome based forward guidance, the second one, calendar based forward guidance, and then we also have open ended forward guidance. Now, let's quickly discuss each one individually. So, the first one, outcome based forward guidance, is when the central bank will basically guide the markets on their future and current policy intentions by giving specific and quantitative outcomes for the current policy. So, for example, they can say that interest rates will stay low until they reach a specific inflation target. So, until they reach a 2% inflation target, or until they reach specific unemployment targets, like let's say 4%, or until they reach specific growth targets. Now, that way, the market will know that rates will stay long and will only start to price in potential changes or anticipate potential policy changes when we get closer to those specific targets, those specific outcomes. The second one is calendar based forward guidance. Now, that is when the central bank will give a very specific date until any type of changes can be expected. So you'll oftentimes hear central banks say things like interest rates will stay at the lower bound, or this low or lower, at least until the end of the year, just as an example. So that will be more of a calendar based forward guidance. Or they'll say that rates won't change, and at least until the end of next year, just as an example. Now, that again can give the markets a clear line in the sand, so to speak, on when they can expect policy changes. But of course, given the market's forward-looking nature, they will often, already be pricing in additional stimulus or other changes to policy by looking at the data in the run-up to that specific date. And the third one then is open-ended forward guidance. Now, this can be a bit of a more uncertain option and can create some unwanted volatility in the market. Now, an example of this can be when the bank says something like rates will stay low, or this low or lower for an extended period of time, or until the economy has shown clear signs of improvement, or until we reach our inflation goals and see growth stabilize. Now, that is a really open-ended statement because there's lots to go by in that particular statement. When exactly the economy will show stabilization and growth, and what do they see as that? What do they mean when they say stabilization and growth? What's the number behind that? So that is a more qualitative statement. And that can be sometimes a little bit more on the uncertain side and won't really create a lot of the normal reactions that a central bank will want to see from that type of statement. But it can also create, a very definite line in the sand. So if they say things won't change until we say so, until we say the growth is stabilized, that of course leaves us in the hands of the central bank. So that's also one of the options they can do. Now, the efficacy of forward guidance will, of course, largely depend on the bank's credibility. If no one believes the bank will do what they say they will do, then forward guidance is pretty much useless, right? But on the other hand, if the bank is credible and does what it says, then just saying that they will do something will often create the type of market reaction that they want, and can even lead to the bank not really doing certain things as a result of that. Now, a good example of this was the recent Fed announcement in March 2020, where they said that they will buy or start buying corporate bonds and ETFs. And that actually saw corporate bond ETFs move higher across the board in the run-up, even though the Fed hadn't actually stepped in to buy them. The market actually already bought that in anticipation that the Fed will do it because it was part of their forward guidance. So that's just a quick example of when the forward guidance itself can actually see the reaction that the Fed is wanting or that the central bank is wanting without them actually doing it in the market. So I hope that helps, Colio. Any other questions, as usual, don't hesitate to let us know.